Hi there. Today we're exposing the real truth behind the 25% tax-free pence and cash in 2026. Whether taking it now, delaying it, or leaving it can cost you thousands.
Okay, if you have a UK pension, you really need to listen up, because the way you handle your tax-free cash is about to change forever. In fact, the safe advice from just a few years ago could end up costing your family tens of thousands of pounds. To make sense of it all, we're going to walk through a fantastic guide put together by the expert tax advisors over at My Tax Accountant. They've laid out exactly what's coming, and more importantly, what on earth you can do about it.
Right, get this date in your diary, April 6, 2027. Seriously, this isn't just the start of another tax year, it's a hard deadline. After this day, a really valuable pension advantage that's been around for years, well, it just disappears. That old wisdom of just leave your pension alone to grow could suddenly become a very, very costly mistake.
And look, these changes are complicated. That's why we're leaning on this detailed analysis from the team at My Tax Accountant. They have a brilliant reputation across the UK for giving clear, no-nonsense guidance, and they've really mapped out this new landscape and the crucial choices that we're all now facing.
And here is the problem in a nutshell. For years, probably decades, the best advice was simple. Leave your pension pot untouched for as long as you possibly can, right? Let it grow tax-free and then pass it on. But because of these new rule changes, that exact same strategy is turning into a serious tax trap. We'll show you exactly how in just a moment.
So here's how we're going to break it all down. First, we'll look at the big tax shift itself. Then we'll get into the new rules that have replaced the old system. After that, we'll dive into your three main strategic options, point out a critical trap you absolutely need to avoid, and then wrap up with how to figure out a plan that's right for you. All right, let's kick things off with Section 1, a pension tax shift. What we're talking about here is a huge change in how your pension interacts with inheritance tax, or IHT. For a lot of people, this really is the end of an era. This timeline just says it all, doesn't it? Right now, and up until that 2027 deadline, most defined contribution pensions are just incredibly efficient. They sit completely outside your estate, which means you can pass them on to your family totally free of inheritance tax. But after April 6, 2027, the rules completely flip. Unused pension funds are going to be pulled into your estate for IHT, just like your house or your savings. And that is a massive deal. It's estimated that nearly 40,000 more families will get hit with an IHT bill because of this change alone. Okay, so with that big picture in mind, let's look at the new rules that are causing all this. The old lifetime allowance, that's gone. It's been replaced by a new system of lump sum limits, and understanding these is absolutely key to making the right decision for you. First up, you've got the lump sum allowance, or LSA. The easiest way to think about this is it's your personal pot of tax-free cash. It's the absolute maximum you can take from all your pensions over your entire lifetime without paying a single penny of tax. For most of us, that limit is £268,275. And then there's its big brother, the Lump Sum and Death Benefit Allowance, or LSDBA. Now this one's a bit broader. It includes the tax-free cash you take during your life, that LSA we just talked about, but it also covers certain tax-free lump sums that can be paid out if you happen to pass away before you turn 75. The limit for this one is much bigger, just over £1 million. You know, what's really interesting here is how it shows the government's complete shift in thinking. Under the old system, the lifetime allowance put a cap on your total pension savings. If you saved too much, you got hit with a tax charge. In this new world, there's actually no limit on how much your pension can grow. The focus has moved completely. Now HMRC only really pays attention when you start taking out those tax-free chunks of cash. It's a subtle change, but a crucial one. And that brings us right to the heart of it all. With these new rules and that 2027 deadline creeping ever closer, you basically have a playbook with three core strategic choices. Let's walk through them. So here they are, your three choices. Do you take all of your tax-free cash at once in one big go? Do you decide to take it out gradually as and when you need it? Or do you follow that old advice and just leave it all completely untouched for your loved ones? Each of these paths leads to a very, very different outcome, especially after 2027. Okay, in this next bit, we're going to really get into the nitty-gritty of each of these options. We'll look at the good, the bad, and who each strategy might actually be best for. You'll definitely want to hear this part, as it's where all this theory starts to meet real life. Let's kick off with the first option, the one a lot of people think of first, taking your full 25% tax-free cash entitlement in a single lump sum. So the big pro here is just certainty, isn't it? The money's in your bank account, it's yours, safe from any future government tinkering. People often use it to clear the mortgage or maybe help their kids out. And with those IHT changes on the way, you could gift this money, and if you live for 7 years, it's out of your estate for tax purposes. But, and honestly, this is a huge but, there are downsides. As soon as you take taxable income from the rest of that pot, you trigger something called the Money Purchase Annual Allowance, the MPAA. This is so important. It slashes your annual pension contribution limit from £60,000 all the way down to just £10,000. Plus, once that money is outside the pension, any growth it makes could be taxable.
So, what if you don't need all that cash in one go? Well, that leads us nicely to strategy 2, taking your tax-free cash out bit by bit. This one gets a lot of attention because it's just so flexible.
Right. This is often done using something called an uncrystallized funds pension lump sum. It's a bit of a mouthful, I know. But the idea is pretty simple. Every time you take a withdrawal, 25% of it is tax-free, and the other 75% is just taxed as regular income. The big plus here is tax efficiency. You can take out smaller chunks to manage your tax bill, hopefully staying in a lower tax bracket. And all the while, the rest of your money stays invested, growing tax-free inside the pension. The cons? Well, your pot is still exposed to the markets, so it could go down. And, just like the first strategy, the moment you take that first taxable payment, you trigger the MPAA and that lower $10,000 contribution limit. This catches so many people out.
And now for our final strategy, the one that, for decades, was the go-to choice for so many people. Doing nothing at all, just leaving your pension untouched to pass on to your family.
And this is where we hit the single biggest danger in this new pension world. It's something my tax accountant calls the double tax trap. For anyone who passes away after that April 2027 deadline and is over 75, doing nothing is now, by a long way, the riskiest strategy of them all.
This chart shows the brutal reality. Let's imagine a £100 pension pot. First, after 2027, the whole thing is dragged into your estate and gets slapped with a 40% inheritance tax bill. So, poof, £40 vanishes instantly. The remaining £60 goes to your beneficiary, but when they want to take it out, they have to pay their own income tax on it. If they're a higher rate taxpayer, that's another 40% tax bill, so another £24 is gone. So as you can see, of the original £100, a staggering £64 can just disappear in tax, leaving only £36 for your loved ones. It's just brutal.
Now, whichever one of these paths you might be leaning towards, there is a critical trap you have to know about, especially if you're planning to keep working and paying into a pension. It's called pension recycling, and it's a rule that trips people up all the time. So stay with me, this next part is incredibly important.
On the surface, the idea sounds quite clever. You take your tax-free cash out, and then you pay it straight back into your pension to get a second round of tax relief on the very same money. But, as this quote from Royal London makes very clear, HMRC is wise to this. They have really strict rules to stop what they see as, well, an abuse of the system.
Basically, HMRC has this 5-point checklist to spot recycling. Now, they'll only take action if you meet all 5 of these conditions. It involves taking out a lump sum of over £7,500 and then making a pre-planned and significant increase to your normal pension contributions. If you tick all of their boxes, your tax-free cash can be reclassified as an unauthorized payment, and that comes with some really nasty tax penalties. It is a real trap for the unwary.
So, we've covered the huge tax shift, the new rules, the 3 main strategies, and a major trap to avoid. Let's try and pull all of this together and talk about how you can actually decide on your own personalized plan.
This summary table is a great way to see all the trade-offs side by side. Taking it all gives you high initial flexibility and can slash your IHT risk if you spend or gift the money, but bam, that MPAA is triggered. Taking it slowly offers great ongoing flexibility and helps you manage your income tax, but again, the MPAA gets triggered, and there's a medium IHT risk on whatever you leave behind. And as we've seen, doing nothing, well, that now carries a very high IHT risk, all because of that double tax trap.
So, the most important takeaway from all of this is, there is no single right answer. There just isn't. There's no one-size-fits-all solution here. The absolute best choice for you will depend entirely on your unique circumstances, your age, your health, any other assets you have, your family situation, and what you actually want to achieve in your retirement. Now, it is really important for me to state this clearly. This has been a guide to help you get your head around the changes and your options, based on the brilliant analysis from my tax accountant. It is for general information only and is absolutely not financial advice. These are complex decisions with very, very long-term consequences. And because of that, getting professional, regulated advice is absolutely essential before you take any action. For a personalized plan that's tailored to your specific situation, you can get in touch with the expert team at My Tax Accountant using the details you can see on your screen now. Their advisors can help you navigate all of this properly. And for more excellent updates like this one, do make sure you subscribe to their YouTube channel.
So, we'll leave you with one final question to think about. With everything we've covered today, is your current pension plan truly ready for what is probably the biggest tax shift we've seen in a decade? Thanks for watching.